It was no easy feat managing in fixed income last year. How did you navigate the environment?
Well, it's challenging times. Many expect bond yields to move higher, and they eventually will. They can't go much lower, but it's a matter of when, and we're always looking for that right blend of risks. And so last year we focused an awful lot on U.S. domestic securities, commercial real estate bonds or corporate bonds, and really steered pretty clear of the emerging market volatility. That served us quite well.
A lot of your top holdings are U.S. Treasuries, which might be a little contrarian. So what are you doing on the duration side, and how is that changing in 2014?
We've generally been constructive on duration. We're starting to lean into a more defensive bias. We think the Fed will eventually start to raise rates, but in our view, that's not until late 2015, early 2016. And when it does happen, it'll likely be more modest than many expect. So that's allowed us to stay more invested in duration risk and earn extra income during that period. Now, as the environment changes, we'll have to tact, as always. But it's been too early to be too defensive. We think many peers have gotten off sides too early. There's just not enough inflationary pressure in the economy today to really have a destabilizing move higher in yields, in our opinion.
I'm curious, when you say it'll be more modest than most people think, what are your expectations then? It's so funny, we haven't had to think about interest rates rising this way or Fed move higher. So, typically we would see a quarter point move.
We think that they'll start gently once they do start, but ultimately it'll be a relatively quick series of moves to get to something either side of 2%. In our opinion, that would put the Fed funds rate even above inflation right now, which is modest at the 1.5% level for core, and if anything, falling. So in our opinion, much beyond that level it would have to have a different economic environment. And what that means to us is that 10-year Treasury is really unlikely in the coming years to push through 4%. And that's quite a bit lower than many expect. And we also think that an awful lot of people would love the opportunity to buy a risk-free or nearly risk-free 4% income earning security. And that's part of the story as well. A lot of people have a demand for yield. That's not changing anytime soon.